and welcome back to Dukoscopy TV. I'm Natalie MacDonald. Now, he may have been away for some time, but back for a new series of Hollenbeck Unleashed. It's Dr. Frank Hollenbeck. Dr. Frank, thank you for joining us. It's Hollenbeck re-unleashed almost.
Well, it's good to be back.
Now, there's been a lot of discussion, largely regarding EU politicians, about a separation in the banking industry of investment banking from commercial banking. We've had in the UK the Labour proposal, should they come into power, they want to separate investment and commercial banking. And we've also got the EU banking report now. Can you tell us a little bit more about that?
Well, yes, it's true. We've had a lot of activity on the regulation front, the regulation of banks. For example, we've had the Volcker rule in the United States, and in the UK, we've had the Vicker rules. And we've just published a report that was actually supported by the EU. It's known as the Lincoln Banking Report. And this report basically talks about just that, separating investment banking from commercial banking. Now, all of this is similar to what we had in the 1930s, the 1933 Glass-Steagall Act, in which we basically separated investment banking from commercial banking. Now, this Lincoln report, they're basically saying is that, well, commercial banks can still do investment banking, but they can only do so much. In other words, they can still do investment banking, but they're limiting the amount of investment banking that they can do. Okay, so essentially what they're going to do is they're going to weight assets relative to their risks. Okay, and then once you get to above a certain level of those risky assets, then you have to separate them off into a subsidiary of the company. Okay, that's the essence of this report, is that you can only take so much investment risk. So in other words, some of the investment risks that you take will be the hedging activities relating to foreign exchange risk or interest rate hedging for corporate clients. Okay, another aspects of of this report is it would put limits, for example, on bonuses, banking bonuses is another aspect of it. The clear thing, though, in this study is that it basically put a lot higher risks, or risk weighting, I should say, to derivative products, okay? And it would also put a much higher risk weighting on products relating to real estate or real estate related activities, okay?
As such, what are the problems with this idea then? Well,
for me, I have a variety of conceptual problems with this report, as well as philosophical problems. We have a situation where we have a deposit. In other words, when you earn income, you make a deposit and you intend to pay your rent and your food at the end of the month. Okay, you expect the money to be there. What you don't realize is that the bank takes that money and takes risks with it. Okay. Now, to ensure that that money is there, the government guarantees it. Okay, that's FDIC or European Deposit Insurance. The problem, though, with deposit insurance is the moral hazard effect, in the sense that what happens is that it privatizes the gains and it socializes the losses. So it induces banks to take on more risks. Okay, in the sense that they basically go to the casino. Okay, and what happened in the case of investment banking, we repealed the investment banking, the Glass-Steagall Act, which separated investment banking from deposit banking. When we repealed it in 1999, we basically had the banks in the casino and just end up playing more risky games. Okay, so now we're in a situation we're saying, oh, gee, the banks are in the casino and they're playing all these risky games. So what we're going to do is we're going to regulate it, okay, and we're going to tell them which games they can and cannot play, and we're going to put risk weights on the different types of games. The real problem isn't that. The real problem isn't telling banks what games they should play in the casino. The real problem is banks should not be in the casino in the first place, in the sense that the problem we have is that they should not be risking your deposits. We should have a separation between deposit banking and loan banking. We don't really need a separation of commercial banking and investment banking. What we really need is a separation between deposit banking and loan banking. That's the key.
So ultimately, are you saying that this won't solve sort of future financial crises then?
Well, the view of this is that this is going to solve our problem. It's like we've never had a financial crisis before. The first major financial crisis actually occurred in 1720, and we had the financial crisis of 1819 and the financial panic of 1907 that led to the creation of the Federal Reserve System. It's as though what was investment banking a problem back then? Investment banking did not exist. The cause of these financial panics, or these financial crises, I should say, these financial crises over 250 years have been due to two things. Okay, the first one is the government's creating money out of thin air. And when I say governments, I don't just mean central banks, I also mean treasuries, as in the case of 1720 John Law, Mississippi bubble. Okay, and we have banks creating money out of thin air through the fractional reserve banking system. So what we really need to do to have a sound financial system is really to basically eliminate the fractional reserve banking system. Okay, and if we did that, then we wouldn't need financial regulations of bank. You know, no more than we would need to regulate the makers of potato chips. Okay, in other words, what would happen is that we'd have loan banking. Okay, and if you put money in a loan bank, it's like buying a stock. You know you're taking a risk, okay? And then we have deposit banking, so you know your money is safe and you don't have to worry about it, okay? And if the bank does bad things with your money and you were in loan banking, well, that's your fault, you know? Just like, you know, a company can go bankrupt when you buy its stock. And that's really the way we should set up our banks, is we need to separate deposit banking from loan banking.
Dr. Frank, great having you back with us. Great comments. Thank you. We'll be back next week to discuss another hot financial topic. For now, though, goodbye.